Hi guys. Good afternoon. Thank you for coming online. Can you all hear me, by the way?
Yes, sir.
Oh, okay. Right. So this is the corporate banking class. Now I need to check whether I'm in the right class and whether you all are in the right class. We are doing corporate banking, right?
Yes, sir.
Oh, fantastic. Okay. Well, looks like it's a small class with about 10, maybe 7 of you online. Can we just start with an introduction of yourselves? I can see your names. Maybe you can tell me where you work, what you do there, so that I know where to pitch this, at which level I should pitch it. Should I pitch it at 33,000 feet, or should I pitch this at ground zero so that everyone will understand? Can we start with the basic introduction? Well, my name is Shashika. I work for Sri Lanka Insurance. I've been a bank for a little over 10 years. Yeah. And also corporate treasurer. My background is mainly in treasury and fund management. Well, that's about me. So just tell me about yourselves, where you work, what do you do there, what are the studies you have done, whether it's banking or SEMA or whatever, right? Yeah. So let's start with you. The first one on the list I can see is Elizon. Sorry, how do you pronounce your name?
Alizan.
Elizon. Very sorry. Yes.
So I'm new in banking. I'm attached to NDB, corporate office. My background, I've had my diploma and my master's in management.
Okay. So are you with my friend? I forget her name. One moment. Santoshini, sorry. You know Santoshini?
Not really.
Okay. Fine. Thank you. Dennis?
Yeah, I'm Dennis Olagodua, working for National Savings Bank as regional manager for Northwestern region.
Northwest, okay.
Yeah, Kurunegala and Putlam.
Kurunegala and?
Putlam.
Okay.
Yeah, okay. And I have completed my degree and MBA and the banking and postgraduate diploma, and I have completed the several diplomas conducted by IBSL.
Very good. Yeah. Gayan?
I'm Gayan Fernando. I work at Sansa Development Bank at Recovery Department. I did complete my banking and did 2 diplomas in IBSL also.
Right. Kaushalya.
I'm Chandima Kaushalya. I work at Bank of Sri Lanka as a staff assistant. I completed my IBSL and degree also.
Okay, good. Pushpa Kumar. Pushpa Kumar. Hello? Fallen asleep? Yeah, okay, no problem. Rasika? Rasika Gardiheva. No, okay. Sampath Fernando.
I'm currently at Ceylon Bank, working at Ceylon Bank branch. I have done my.
Hello?
I am attached to Ceylon Bank.
Sorry, couldn't hear you.
Attached to Ceylon Bank.
Ceylon Bank, okay. Sampath from Ceylon, yeah, 2 banks.
And
Yeah.
I have completed my banking.
Uh-huh. All right. Okay. So what do you do at Ceylon Bank?
Currently work in the branch.
Hmm?
In the branch. In the branch.
Okay. Sandhya. Sandhya Lekhamke. Takshila Ratnaik.
I am Nuani.
Ruani.
Nuani. I
Yeah.
am from National Savings Bank, Risk Management Division. I am heading the Market Risk Management Unit and Treasury Middle Office of the bank.
Hmm.
And nearly 7 years, before joining the bank, I worked as a research analyst. Now, almost 7 years in the Risk Management Division of NSB.
Okay. Right. Very interesting. Very interesting. So, in your view, what is the most significant risk you see these days?
It's of course the credit risk. Apart from that, actually based on the exposure the bank has, there will be a market risk, of course.
Sorry, which exposure? I couldn't get you.
Based on the investment exposures,
Okay.
the market risk also increasing.
Market risk is
Moreover, yes, the default credit risk because of the
lockdowns and all.
moratoriums, and also the market player is also highlighting because of these lower reserves and pressure on dollar. The
Yes.
most of banks who has exposures in USD, especially SLDB investments, have FX risk faced.
Okay, SLDB. Okay, good, very interesting. Taranga.
I am Taranga Gamlat.
Yes.
I work in NDB Bank in Rajagiri branch, attached credit department.
Attached to audit.
Credit department.
Credit. Okay.
I completed IBSL DABF diploma.
DABF. Yeah.
Oh, DABF. Yes.
All right. Okay. Udesha.
I'm attached. I work for commercial leasing and finance at the operations sector. And I previously worked at Nations Trust Bank as a banking assistant. Now here I'm a junior executive.
Okay. Ziad.
Hi, I'm attached to DFCC Bank. I work in Personal Financial Services Department, Central Operations. Before that, I was at Axis actually.
You were?
At Axis Bank.
Sorry, I couldn't get it.
Axis Bank.
Axis Bank. Yeah. They closed down, right? They closed down operations.
Yes.
Yeah. But they're quite big in India, right?
Yeah, exactly. They are like the third biggest bank in India.
Okay. You said you're now at NTB.
I'm at DFCC.
DFCC, sorry. Yes.
DFCC, yes.
Yeah. Okay, thank you. Very interesting. So very interesting profiles. All of you seem to be very experienced in banking. Some of you are already in corporate banking. Some of you are not. Some of you are managing risks. Some of you are attached to the branch. And well, I think it was Sandhya who said that risks are increasing, mainly the default risk. It was Sandhya, right? Who said that? NSB risk?
Nuani. Takshila.
Ruani, yes. Yeah, sorry. Okay. Very interesting point. So what you said is absolutely right because of COVID-19, right? So unfortunately, we are unable to meet physically and interact. Now, this should ideally have been an interactive session where rather than me speaking and this being like you listening to a discussion on TV, it shouldn't be the case. right? Ideally, we should have been able to interact, but times are such that we have to adjust. The way we operate has to change completely, and the faster we adapt, the better. Because this is going to be the new norm, probably, right? For, well, at least until half the country is vaccinated, which is happening. So that's the good news, and hopefully things will get back to normal very soon. Well, unfortunately, 2020, it was a complete washout. If you take your exams, for example, I don't know whether any of the diploma courses were conducted, but at least the exams were conducted, but there were not a single banking exam last year. So what it goes to show that is that if there is anything you need done, don't postpone anything. Don't, right? Because you never know what is going to happen in the future. So if you can acquire a qualification, get it as fast as possible. Because if you try and postpone it, you might end up postponing it indefinitely. Right? Some of you may have had the opportunity to complete some of your exams in 2019. So you wanted to take it easy. You thought of postponing things, and you may have noticed that things have got dragged for more than 2 years. You could have finished it in 2019. Right? So you're living with the same sort of burden for 2 years, which you should have buried sometime back. Right? So get your qualifications done as fast as possible, and gear up for the new norm. So this is also a chance where all of us have an opportunity to upskill ourselves, right? Upskill, increase our skills rather than, well, we have lots of time to spare, isn't it? Most of us are working from home. We save a lot of time that we normally spend commuting. We no traveling around the country. So weekends also we are stuck at home. The only thing you could do is probably learn something new, right? So take it in a positive way. And when the country and the world opens up, then you're ready to hit the ground running, and you'll be a new person, right? So that's what you should aim for, right? Okay. COVID-19. Now, everybody knows it. You can do a thesis on COVID-19, but the amazing thing is, it began in China, in Wuhan, right? But it spread all over the world, and the world came into a complete standstill, isn't it? The whole world was locked down. Unbelievable. About 2 years ago, if you had said that the whole world will come to a halt, everything will stop, people will start working from home, none of you will believe it. Right? But today, it is the reality. Right? So the world is so dynamic. You never know what is going to happen tomorrow, isn't it? So the best is to be very flexible. You should be able to change, adapt with things, and move on with life, right? Yeah. So as I said, COVID-19 started off as a health crisis, but right, like Rooney just a few minutes ago said, very rightly said, it has now blown into it's now a fully blown financial crisis across the world. Now, the funny thing is, every 10 years, there is some sort of a crisis in the world, right? So before COVID-19, which was, as I said, a health crisis, and it is now a fully blown financial crisis, we had the subprime mortgage crisis in the US, right? It had an impact all over the world, not only in the US. And so my point is, what began in China is now a global problem. Okay, perhaps China has the lesser problem. The entire world is suffering. So no one is in watertight compartments. No economy operates in a watertight compartment. What happens in a distant part of the world can have an impact on you, right? So as corporate bankers, that should be in your mind. Yeah, because your customer, you should be aware of your customers. You should, bankers have a fiduciary responsibility. They should be working in the best interest of their customer, right? So this is a value addition that you can provide to your customers. You should be able to foresee things that might happen in the future. Yeah. So this COVID-19, which began in China, some of you may have perhaps thought that it might spread all over the world and there can be significant repercussions. Yeah, so it's good if you can keep your customers alert, right? So that they will appreciate your service. That's value addition that you can provide to your customers. Okay, so that is what separates the boys from the men. How much value you can add to your clients. So it shows that there is nothing which is insulated from the world. A small event in one small town can have a huge impact on the entire world, right? So 10 years ago, the subprime mortgage crisis, the entire world suffered. Okay, it happened in the US. What is the subprime mortgage crisis, by the way? By the way, the ground rules for this session is
it's regarding the investment in real estate, pool of real estates. Investors invest in this real estate suddenly when the prices are high, real estate prices, and once the bubble boosts, the real estate prices get declined, and the investments companies affected because of this.
Very good, very good, excellent. Right, so it was as you rightly said, a mortgage crisis in the US, right? So what caused this crisis? And before the subprime mortgage crisis, we had the East Asian economic crisis, right? 10 years before the subprime in 1996, 1997, which had a huge impact on some of the East Asian countries like Malaysia, Thailand, right? Indonesia. Yeah, that is where they ran short of dollars. What happened was during the East Asian economic crisis, some of the central banks in these East Asian countries were very adamantly defending the local currency. Right? They were intervening heavily in the market. They were selling down their reserves to keep their local currency strong against the US dollar. Right? But now it was artificially done. They did not allow market forces to determine the exchange rate. They rather wanted to keep the local currency artificially strong or the dollar artificially weak. Right? So eventually they ended up spending their reserves. Right? The reserves depleted. These countries had no reserves to defend the currency anymore, and there was actually a shock in the exchange rate. Right? Exchange rate shock. East Asian economic crisis. So the Indonesian rupiah got hammered, and it went above 10,000 rupiah per dollar. Malaysia suffered a lot. So did Thailand, right? And then came the subprime mortgage crisis. Now, the subprime mortgage crisis happened because early 2000s, right? That is when Alan Greenspan was the chairman of the Federal Reserve. By the way, who is the current chairman of the Federal Reserve? What is the Federal Reserve? By the way, ground rules, I could mention at the beginning. We agree during the sessions, we agree to disagree, right? So don't believe everything I say. You don't have to believe everything I say. You can slice and dice. Feel free to question me. Make maximum use of this time, right? So that you enhance your knowledge, not just pass an exam, but also enhance your knowledge. Now, what do you think happened? Yeah, okay. So Alan Greenspan was the Federal Reserve chairman. Who is the current? What is the Federal Reserve, and who is the current chairman? Those were my questions. What is the Federal Reserve? Federal Reserve.
Is the central bank of US?
Very good. The central bank of US is called the Federal Reserve, right? Who is the current chairman?
One Mr. Powell.
Yes, Jerome Powell.
Jerome Powell, yeah.
Right, good. Okay. So about 20 years ago, when Alan Greenspan was the chairman, now Alan Greenspan at the time was about 70 years of age, right? Even today, when Alan Greenspan speaks, the market starts moving. Market reacts to his statements. He was a well-respected chairman of the Fed, a very committed guy. But now, when he was chairman during early 2000, US interest rates were around 0%, nearly 0%. So return on investments for these banks about 1%, very low. Right? So these banks were not happy with a 1% return to their shareholders. They wanted to increase the return. So what did they do? They went out aggressively and took additional risks, right? So they went to people who did not have any assets, no job, no repayment capacity. They started lending out to these guys, right? So they are below the prime customers. That's why it's called subprime. It's subprime customers. And it was called a predatory lending, giving a loan which the customer, you very well know the customer might not be able to pay. And it's called predatory lending. So being bankers, corporate bankers, you should be aware of that. Because if you abuse this and if you are found guilty of predatory lending, you can be sued. So make sure your customer has the capacity to repay his loans. Now, we all are masters of credit, so I will not dig deep into it. But remember, there is something called predatory lending. There is also predatory borrowing. The opposite of predatory lending, you artificially try and show that you are able to borrow. You have the capacity to borrow, but actually you don't have. That's called predatory borrowing. So with predatory lending, banks were lending aggressively to subprime customers, and initially interest rates were low, so they were able to service their debt, right, one way or the other. Now, what these people did was they got loans and invested in property, right, in the US. So they started investing heavily in property. Whatever money they got went to the property market. So the property prices in the US started going up. Now, this was early 2000. Property market started going up. Now, gradually people saw their houses appreciating in value, right? The property market going up. Now, that brought in more buyers into the market. More and more people started buying, investing in property because the value is going up. Yeah. Now, this continued. And it eventually became a bubble in the US, right? Now, how did the bubble burst? When people started taking more and more loans, inflation in the US started picking up. So the Federal Reserve had no choice but to increase interest rates because they wanted to keep inflation below their benchmark rate of about 2%, right? Their target inflation rate is 2%. So they wanted to keep inflation below 2%. As a result, interest rates had to be increased. Now, when interest rates increased, most of these loans to subprime customers were structured on floating rates, floating rate loans. So when interest rates start going up, the amount of interest they have to pay on their loan also goes up, right? Quite obviously, because the rates are not fixed. So the installments started picking up, and these guys are subprime. They don't have repayment capacity. They found it very difficult to service their loan. Now, one by one, loans started defaulting. And when the loan defaults, the mortgage, the land is acquired by the bank and it's sold out, right? So this started happening, not just to one customer, but to many, right? Across the board, so many defaults started happening. And then banks all of a sudden became real estate companies. They were selling properties, right? So the bubble burst. That triggered the bubble to burst, the housing bubble in the US. So with that, the market started coming down, right? So all of a sudden, the mortgage, the property market, with the real estate market, which was booming, all of a sudden collapsed, right? Just because interest rates increased. Now remember, it was interest rates which triggered a collapse in the housing market. Okay, so interest rate market has an impact on the housing market. Remember what we discussed earlier? The health crisis in China, right, ended up being a financial crisis, right? So one kind of risk can lead to another kind of risk. It's not that an interest rate risk will always remain only interest rate risk. No, it will affect all other markets as well. Okay, so that's why I keep telling you that nothing is immune. Anything that happens in the world has an impact on the other end of the world, right? You don't even know sometimes that there will be an impact, but eventually when it hits you, then only you realize, this is what caused it. It might be too late. And so it's very important that we are proactive. Okay, going back to the subprime mortgage crisis. Now this triggered a collapse in the housing market. Okay, let me put it in a diagram. So let's say, can you all see the board? Okay. Can you all see this? Right. So let's say this is the loan amount. Okay. Now the customer has an incentive to settle the loan if the value of the property or the security is above the loan or below the loan.
Above.
Yes, if it's above, right? So if this is the value of the security of the mortgage, then there is always an incentive to settle, right? Now, there is a higher incentive or a big incentive to settle at A or at B. What do you think? This is the time, and this is the value. Where do you think the loan, is most likely to be settled? At A or at B? B. Why?
Value is higher than.
Yes, because the value is much greater than at A, right? So if a customer defaults at this point, he will technically lose only this amount. But if the default happens here, he stands to lose a much bigger amount, right? So loans are unlikely to get defaulted at B, likely to be settled the higher the price of the security. Now, when the bubble burst, all of a sudden property prices started crashing. A very steep drop in property prices. And the value of the security eventually fell below the loan amount. Okay, so if the loan was for $50,000, the value of this property dropped to $30,000. Now what do you think will happen? What will happen?
Customers won't pay the loan.
Yeah, there is no incentive to settle the loan. Why? If this customer settles the loan, he will get an asset, right? He will get an asset which is now worth only $30,000, but he has to pay $50,000 to settle the loan, right? And he ends up with an asset which is now worth only $30,000. So if this customer is a rational thinker, what should he do? Should he settle the loan or should he default? He should. Should he settle the loan or default?
Default.
He should default. $20,000 profit, isn't it? Yes. So obviously they started defaulting, right? Now more and more defaults got triggered. Okay, that's because the value of the security fell below the loan amount. So more people were willing to default, even genuine customers. The prime ones also started defaulting. There is absolutely no point settling your loan, right? And when defaults got triggered, banks got stuck for liquidity. No liquidity in the market. Banks are not getting the inflows. No settlements coming in. Liquidity risk. Right? Remember, it started with interest rate risk. Right? Interest rate risk was the starting point. It moved to property prices risk. Then liquidity risk. Liquidity risk. The moment banks get stuck for liquidity, that is the end. That's the end. Because banks are supposed to be liquid. If a bank is found to be illiquid, that is a huge damage on their reputation. And if they cannot service their obligations, they will default. That will trigger a default. So that is what happened. That is why Lehman Brothers sank. And Lehman Brothers, giant. A giant in the US sank because they did not have liquidity. What do you think is more important, profits or liquidity? What is more important?
Both are important.
Okay, why? Yeah, I see where you're coming from, Rudy. But in my view, liquidity is critical, right? Now just imagine, let's just assume that all of you are customers of banks. Each of you have deposited 10 million in your account, right? Let's say you have 10 million bucks in your savings account. So you go to the branch and you ask the cashier to give you 10 million rupees of liquidity, cash. You want to withdraw 10 million rupees, right? So what happens if the cashier gets the shock of his life and he tells you, "Ada inne passer hetain, ada salli nahi." Then what happens? You're happy, you go home very happy. Or do you panic?
Panic.
Yes, you panic. What you do is you take your phone, you call your friend, you tell him, "Me bank mein salary nahi, yande pai." So WhatsApp messages start going around. People start getting panic attacks. More and more people go to the branch or to this bank to withdraw the money. They don't have money. Everyone is coming with withdrawal requests. The bank doesn't have money. Right? May have been a small problem. Maybe cash in transit, right, to an outstation branch. The transport vehicle has broken down, so unable to send it today. The money will be expected tomorrow. Might be a simple reason like that. Can trigger a collapse. Liquidity, lack of liquidity, very critical for a bank, because banking is based on reputation. Right? If a bank does not have a reputation, finish. That's the end of the story. Say, for example, well, people with tainted histories, right? I cannot give names, but people with tainted histories come and open a bank. No one is going to put money, in spite of the returns that they promised, right? No one is going to deposit money. Why? Because no reputation. If there is no reputation, no bank. Yeah. So liquidity is critical. If a bank is making losses, fine. Okay, because banks have so much of share capital. If the bank has 20 billion shares, 20 billion bucks of minimum capital requirements, if the bank makes a loss, that capital can absorb part of the loss. Right? So short-term losses, fine, can be tolerated. But if no liquidity, that's going to be a major problem. Yeah. Now, Ruani, as you rightly said, moratoriums can give rise to credit crisis. Right? So if it comes to a certain point where banks don't get the settlements coming in, they might get short. They might run short of liquidity, isn't it? Because everyone wants a moratorium. No one is willing to settle their loan on time. So banks might go short on liquidity, isn't it? They have a shortage of liquidity. So to ease that pressure, the central bank has printed lots of money. Right? We would have seen recently, I think it was $1 trillion of printed money in the market. Right? So that's to make sure that moratoriums will not negatively affect the banking sector. Because the bank, the system has plenty of liquidity, so that banks can borrow and at least for a short term, manage the liquidity shortfall due to moratoriums. Okay, so that's why the central bank also went on a money printing spree. Right. Okay, so going back to the subprime mortgage crisis, asset prices started collapsing. So this can be seen in any market, not only the property market. Remember 2013?
Sir, I have. Sir?
Yes, Sampath, tell me.
Sir, that the printing of money is only because of that, so there are some other reasons also?
Printing of money?
Is because of only that liquidity issue, or some other reasons are also there, no?
Like what?
That there are expenditures to cover up the expenditures or something.
Yeah, so that's also part of liquidity, isn't it?
Yeah, so yeah.
Excuse me. There is not enough liquidity to cover the expenses. So one way is to print. Okay, again, a liquidity issue. Okay.
Okay.
Right. Good point. 2013-14, we had a owning crisis as well. Owning crisis. And certain banks, about 1/3 of the owning portfolio had to be written off. That's because the same reason, right? The value of gold went to an all-time high and then dropped very steeply. Now, when it was going up, banks were also lending aggressively. Loan to value kept going up. But the moment it collapsed, see, you're dealing with very smart customers. Huh? When the value of the gold falls below the loan amount, they take the smart way out of you. They default. And it's easier to default, cheaper and more profitable to default at that point. Yeah. Now, how many of you have done derivatives? Derivatives. Derivatives meaning forwards, futures, options, and swaps. Have you all done derivatives? Has anyone done derivatives?
I have looked into some of areas in the derivatives, but not in depth.
Okay. How about the others? So let me give you a challenge, right? I would say if you are giving a loan, then you have done derivatives. You have dealt with derivatives. If you have given a loan, indirectly you have done a derivative. Would you agree with it or disagree with that? My argument is that if you have done loans, if you have given loans, then you have done derivatives. Okay, right. So we'll come back to that point later. For now, just keep it in mind. And if I forget to explain, just remind me. Okay. So I want you all to prepare an answer for that, either for or against. The giving out a loan is a derivative. Oh, this is something you will never come across in textbooks. Huh? Never come across it in a textbook. Okay. Right. So this is what happened in subprime mortgage crisis. One after the other, loans started defaulting, and there was a property market bubble which burst in the US that triggered the subprime mortgage crisis. Right. So for homework, I want you to watch a movie. The Big Short. Perhaps some of you may have seen this already. Okay, so go home and you're already at home. Watch this movie, The Big Short. It is all about the subprime mortgage crisis in the US. The Big Short. And I want you to watch another movie called The Rogue Trader. Now, this is fairly popular. The Rogue Trader is about whom? All these are true stories, eh? True stories. Rogue Trader is about whom? Any idea?
Nick Leeson.
About Nick Leeson. Nick Leeson. Who is Nick Leeson?
trader in Bearings Bank.
Which bank?
Bearings.
Yeah, a trader who was attached to Bearings Bank, which
Correct.
was the oldest investment bank in UK, right? 225-year-old bank. And Nick Gleason joined it. He did very well, right? He was a fantastic trader, very aggressive guy. So he was assigned to their Singapore office. Okay. Now, in Singapore office, Nick Gleason was asked to run all three divisions of the treasury, right? The front office, middle office, and back office. Our friend Roni just mentioned that she runs the middle office of NSB Treasury, right? So that is one part of the treasury, the middle office. Okay, so the front, what does the front office do? Treasury front office?
Dealing.
Yeah, that's where the transaction generates, right? So transactions originate at front office. Then what does the middle office do?
Monitoring.
They monitor risks. And the back office?
Settlements.
Just the settlements, accounting, and record keeping. Okay, so the three units have three different roles, and there are three different reporting lines. But Bearings Singapore didn't want any of this because it involves additional costs. So they thought Nick Gleason can do a one-man show. He can do the trading, risk monitoring, as well as settlements, right? So one man was asked to carry out all three operations. So what did Nick Gleason do? He created a fixtures account. That was the account number that he gave, 88888. Right? And this was meant to be a customer account. So he classified this as a client account. And Nick Gleason then started gambling. He took, he entered into transactions beyond his authority. And whenever he made losses, it got parked in this account. It is a bogus account. So although it is classified as a customer account, it's actually the bank itself, right? So there is no actual customer. So all the losses that gets reflected here was getting reflected as a profit in the bank's accounts, right? But overall, the bank was bleeding heavily, right? Because this bogus account was making heavy losses. Nick Gleason covered it up, indicating that it was a client account. So the client's loss was the bank's profit. He made lots of profits, rewarded, right? Now, eventually in his desperation, he made a bet on the Japanese stock index futures, the Nikkei futures, right? Nikkei. He thought he did what is called a short straddle, expecting the market to be stable, right? He went short a straddle. Short means he sold assets, right? We'll come back to short later. So he went short Nikkei futures. But all of a sudden, there was an earthquake in Japan, right? And the market just crashed, collapsed. So all the futures that he sold got triggered. Right? Put options of his short straddle got triggered. And this account got hammered with losses, heavy losses. So the bank couldn't take those losses. They were short of liquidity. They can't settle. Not enough cash to settle. Default. Right? So Nick Gleason knew this had happened. He knew that it had hit the fan. And he wrote a small note and said, "I'm sorry," and ran off. By the way, can you all see the board very clearly, or it's small?
It's a bit small, sir.
Okay. Better? Can you see it now? Can you see the board now? Hello? Can you all see the board now?
Yes, sir. Now it's good.
Okay. Sorry about that. Right, so Nick Leeson wrote a small note and said he's sorry and ran off. But he was caught and sent to prison. 3 days after this trade, the bank collapsed. 225-year-old bank collapsed in 3 days. Right. So it was sold to ING, and ING Bank bought it for £1. Just £1 to buy Barings Bank. And it was called ING Barings. About 10 years down the line, they sold it for $225 million. So they made a killing on this purchase. So Nick Leeson got caught and was sentenced to 6 years in prison. But he was bailed out in about 4 years. And while in prison, he wrote a book called The Rogue Trader. And that is the story of Nick Leeson. Now this movie glorifies Nick Leeson to a certain extent, which may be true, may not be true. But it all happened because Barings had lacked controls. There were no controls at Barings. Nick Leeson was running a one-man show. He was like a bull in a china shop. Okay, so it's very risky. But eventually, Nick Leeson ended up making lots of money from this book. And he ended up buying a football club. He bought a football club, so he made that much of money. And he's taking lectures on risk management. And so he's minting money and speaking about risk management. So it's a must that you watch this movie, The Rogue Trader. Then you can also watch The Wizard of Lies. The Wizard of Lies. This is the story of whom?
Bernie Madoff.
Very good. It's about Bernard Madoff. The Wizard of Lies. Watch this also. Bernard Madoff ran the biggest Ponzi scheme in the world. Right. Biggest Ponzi scheme in the world. And he wouldn't have got caught if not for the subprime mortgage crisis. Why? Because during subprime mortgage crisis, all the funds were showing huge losses, a bloodbath in all markets. But Bernard Madoff's fund was showing profits. That is because it was a Ponzi scheme, just showing lots of profits, no losses. Right? So what investors did was, they asked Bernard Madoff to liquidate, because that was the only place they were making profits. They wanted to take their money out, because elsewhere they were making so much of losses. Right? And Bernard Madoff ran out of liquidity. No liquidity to settle the redemptions. Ponzi scheme collapsed. Yeah. Okay, so watch these movies. Any questions up to now? No questions? So no questions can mean you either understood everything or you understood nothing.
So yes, I just have one concern. It's not a question, rather. I mean, with all these, restrictions and monitoring and whatever system in place, so still there are loopholes to play with other general people's money, right? Isn't it?
There are loopholes
to play around with money.
Yes, absolutely. Because you can have the best systems or the processors in the world, but you need to have the right people to run the show.
Understood, sir. Thanks.
Yeah. If you don't have the right person, they will always find a loophole, and they can play out. Because just recently, about 5 years ago, this guy called Tom Hayes. Now, you have heard about LIBOR, right? LIBOR?
The dollar pricing, isn't it?
Huh?
The dollar pricing, isn't it? LIBOR?
Yes. London Interbank Repo Rate.
Yeah.
Yes. So this Tom Hayes got together with some other traders and manipulated LIBOR. Right now, you would think that LIBOR is the gold standard of interest rates, but even that got manipulated, right? So manipulations happen, and it always depends on the person who runs the show. So whatever process you have, there will be people who try to make a quick buck by manipulation, through manipulation, right? Because the smell of money corrupts people, isn't it? Right.
Do you want to know how you could have capitalized on this moves with my free YouTube analysis? Well, I'm on top. In this video traders, we're going to take a closer look.
Okay, let's just watch this video. You might understand what happened in the case of Nick Leeson. Let me see how I can share this with you. Hold on. Yeah, that was a good question, by the way. Any other questions until I get this sorted out?
In this video traders, we're going to take
Can you see this video?
a closer look at how Nick Leeson.
Can you see that? Hello?
Yes, sir.
Okay. Okay, let's watch it for a bit.
Brought down Barings Bank. Stay tuned. Hey traders, a very warm welcome to you. Okay, so how Nick Leeson brought down Barings Bank and lessons that we can learn from it as retail traders. Yes, none of us are probably trading the same kind of size, but the lessons are the same, the psychology is the same. Let's look at the timeline. I've done some research on it. It's very sort of shady about what actually happened. Of course, I guess a lot of the stuff is still kind of under wraps, so maybe there's not been publicized, the more technical stuff, because the headline thing is, well, how much he lost, he ran away and all this kind of stuff. But from a trader's perspective, I want to know pretty interesting as to how he did it and the sort of mindset behind it. So this is reasonably close to actually what happened. So he was a directional trader for the Nikkei. So he was basically the Japanese stock exchange futures, just like the FTSE, DAX, Dow, He was basically a directional trader betting on the future direction of that exchange. He was using futures. He was also doing some kind of arbitrage strategy between different exchanges, but ultimately that's what he was being paid for. He was being paid to get the direction right on these futures. In 1993, he made 10 million in bonuses. Supposedly he made 100 million or 200 million from the banks. He got a personal bonus, so he made a decent wedge of cash. However, don't forget, back in those days, a lot of this stuff was done in the pit. So he would have people running the pit. This is kind of how he had this arbitrage thing as well. You'd go on telephone to different exchanges, blah, blah. But ultimately, all we need to know is he would send the runner down to the pit, go and execute the order, he'd come back, he'd fill out the ticket, that's how much he was long. When he wants to close it, he'd send the guy down to the pit again, the runner would go into the pit, put it to the traders, the trader would close the trade. Pretty clunky way of doing it, that's how stuff works. Go check out some other videos about pit stuff, even in the US as well, very interesting. So, the problem with the pit is that very often you're going to get errors, you're going to get mistrades. Someone says they're trading with you and they haven't. You thought you've traded with someone and you haven't. You've lost track because you're doing mental arithmetic of your position size. You thought you've executed 10, they thought you did 100. There's so many room for error. Okay, there's loads of systems that mitigate that, but errors still do happen. Trades get cancelled, all sorts of stuff. So it was commonplace to use an error account. Not strictly, as far as I'm aware, not strictly legitimate, but it was done to kind of push errors in until you could sort them out at a later date. They weren't part of the major trade you were doing. Maybe you were a couple of contracts off, maybe you did this, maybe you did that, and they were rectified as soon as possible, but often that wasn't. It wasn't, what did he say in the article? He said basically, most of the time, errors are rectified as soon as they occur, which is what it should be done. Often, though, people put them in an error account and sort them out when it was more beneficial to the position. So, you've got those two kind of things up. You've got the solid line, these are the rules, and you've got the way people do it. Same in any business, really. There's often that kind of discrepancy sometimes. But this is really the root of how things happen. So he had an error account called this 5/8 account, and 5/8 because the Chinese lucky number was 8, and any errors on the floor were pushed into this 5/8 account. And the idea is that he would rectify this quite frequently. It was quite a common occurrence. Mistrades, this and that, stick them in that account. Next day, be able to trade out of it, and he would put the profit or loss or whatever it may be and square it up, and it'd all be fine. However, one time, which was another kind of trigger which caused the whole thing, he used it to cover up an employee's error. Okay, put error twice there, we don't need to do that. An employee's error. This was big enough. I don't know what the error was, but it was big enough to ultimately get this guy fired. He did something really, really bad. So Nick Leeson tries to cover up for him, sticking in this 5/8 account. When it's in this 5/8 account, this is when things started bad happening. This was a big error. And he was really, instead of rectifying the error and taking the loss, it's kind of the synergy between retail trading and perhaps what he was doing here. Instead of saying, you know what, I need to cut that loss, it's a big loss, it's how many million it may be, it's going to hurt, it's going to sting, I'm going to get a bit of a telling off for it, but I need to pull the plaster off quickly. He kept it in there. He hoped it would come back, because before trades had come back, or they'd been less damaging, or whatever it may be, for whatever reason, he didn't decide to deal with it there and then. This ultimately then caused much more of a cascade of problems for him. He started adding trades to trade out of the loss. How many times have you been there for retail trading? You're down a lot on the day, you try and trade your way out of it to come back positive. You know you're not trading from the right place, you're trading purely for the wrong objectives. It's a big hole. Maybe it's a couple of grand hole for you as a retail trader. For Nick Leeson, it was 100 million hole plus. In 1994, he was down hundreds of millions in this 5/8 account, and his sole thing was to try and get enough money to get a big enough trade to recover that loss. He was going all or nothing. Now, he was basically long Nikkei futures, hoping for a recovery. That was ultimately his position. He was doing some other straddles. He was selling options to fund it as well. So he was getting funding over. At one point, he actually did committed proper fraud, if that wasn't fraud enough, by cutting and pasting 50 million, got 50 million wired to him, something like that. So he really went properly over the line to get funding in so that he could trade these trades. He was selling options so he get premium back and use that premium. All sorts of kind of other intricate stuff. But ultimately, what we need to know is that he was long Nikkei futures, hoping for recovery. Next day, earthquake came out, or not next day, pretty soon after an earthquake came out. He was already long aggressively. He was then buying more during the day to try and prop up this market. Now, that is a real losing proposition. You know, it's a big market in Nikkei. You're only going to be able to stop the flow for maybe a short period of time. But ultimately, you know, when all that money's coming, everyone's selling. Don't forget, we're already in a bit of a recession already, and the earthquake. Same with any trend, guys. Trend bear market, negative news hits it harder. Bull market, bullish move hits it more, gives it more boost. So he was taking bigger and bigger bets to recover loss. The synergy with retail, guys, you know, you're down. You want to increase your position size because you want to get back to recovery because you realise how much of a move you've got to make in your normal position size and how much of an increase in your account size to recover that losses. And you think, oh, what if I increase my position size and get back quicker? Ultimately, blows up your account. Ultimately, this blew up Barings Bank. At one point, he was long $7 billion notional of Nikkei futures. And I've worked out that, and this is literally just mental arithmetic. Someone can correct me if I'm wrong in the comment section below. At about £318,000 per point, if you were to spread back that now. About that, okay, I don't know what the valuation was quite when he was doing this, but approximately 7 billion notional, that's what you would do. So you can imagine this thing swings not only a few points in a day, this thing is swinging hundreds of points in a day, and that's his notional long position. So you've got a 1,000-point move, you can see the kind of damage this thing is doing. Ultimately, you lost 862 million. I've seen different figures out there, but this is the kind of number that's banded around the most. Regardless of the number, the point is, guys, look at the step in the process, look at what's happened. He's done something he shouldn't do at first, the 5/8 account. One little slip. Instead of saying, hey, you know what, I've made a mistake there, let me take charge of the situation and not let this get any worse. He's let it get a bit worse by putting a bigger error into it. So he's really got a bad habit. He's probably got away with it multiple times. I'm not sure how many times he did, but he's got away with it a few times by the errors being unwound, he's traded out of it, whatever it may be. Then it becomes a little bit too big. And of course, now he's so committed to it, and his mind is wired to think, hey, before I manage to get out of it, I'll be able to get out of it again. Why shouldn't I? You know, I'm just going based on previous experiences. He does it. He makes a big hole for himself. He's helped his employee out, so he's kind of got a good heart. He's not trying to screw with this guy. Ultimately, I guess the correct thing was just to say, hey, mate, you're going to have to hold your hands up for that one and take up the chin whatever happens. You know, but he didn't think ahead of it, didn't think of where this would lead to. Now he's basically in such a hole that he's had to commit rule and even more bend the rules, already bending the rules a little bit. Now he's got to break them fully and get money wide to try and undo this damage. I believe at some point as well, Barings reported earnings as well, which he was part of the manipulation for, which weren't true. So this is now escalating hugely. And his one thing is, mine is I'm going to get my money back. If I get the money back and get out of it, I'll be fine. I might lose my job, but at least everything will be fine. And of course, you know, he could have maybe taken a hit there. I'm not sure how much damage that was, pretty severe damage, but he would have been fired. It would have been okay-ish. But instead, he's doubled up, got massive bets right towards the end, as it tends to be. You end up really aggressive, wanting the money back, bang, and it only takes this one then catalyst, which happens with the earthquake. Could have been anything else, and it was game over. He had to run away and eventually got caught, sent to prison, and Barings went under. So, interesting story. Bit of a synergy between, or a bit of a link between retail trading and this, purely because he's a human being. He's a human being, he is a human being like us, and so he's got the same thought process, just on a bigger scale. And instead of us wiping out an account, unfortunately, because there's no risk, there were no risk controls in place, he wiped out Barings. All right, guys, thumbs up for that kind of stuff. See you next one. Take care. Bye-bye.
Okay, so I hope that was clear. Any questions before we move forward? No. Right, so when you come next week, try and watch these movies. Right. Okay, can you all see the slides? Hello?
Yes, sir.
Okay, right. Well, this is what we are going to cover. Right. Now, money markets, debt markets, equity markets, foreign exchange, and derivatives. Right. We will be doing a little bit of regulations. Okay, so what do you mean by money markets? So there are two kinds of markets. No? One is the money market, other one is a capital market. Right. So what's the difference between money market and capital market? Yeah. What's money market and what is a capital market?
Money market is for short-term financing, and for capital markets, it's for long-term financing.
Excellent. So money market is short-term, capital market is for long-term. Short term is money market. Long term will be capital markets. Right. So what are the examples for short term money market instruments? Short term is usually less than 1 year. Short term money market instruments. You have, pardon? Sorry?
60%.
Okay, yes. So you have mainly call money and repo. Then you have capital markets, you have debt and equity markets. Debt and equity. Right. Debt instruments, you can have maybe government debt, corporate debt, right? Government debt and corporate debt. Equity could be listed or unlisted. Okay. So government debt can be treasury bills, bonds. Corporate debt could be commercial papers or debentures. Right. Even in fact, debentures also can be listed or unlisted. Right. So these are money markets. Now, what is a primary market and a secondary market? What is the difference between a primary market and a secondary market?
Primary means it is issued initially, secondary means it is traded later.
Secondary means?
Later, once issued, it is traded later with other.
Yeah, very good, very good. Now, when you get married for the first time, right, married for the first time, then you're trading in the primary market, right? Then when you get married for the second, third, fourth time, or even beyond, then you're trading in the secondary market, right? So that's the difference between primary market. Married for the first time, primary market. Beyond that, anything beyond the first time is the secondary market. So likewise, if a debt or a equity instrument is issued for the first time, it is in the primary market, right? So if a debt instrument, it's called a primary auction. Equity instrument is called initial public offer or an introduction. The secondary market is anything beyond the primary, right? Then central banks and regulators. So is it good or bad of having of a market being regulated? What do you think? Is it good for a market to be regulated, or is it bad?
It is good to have a regulator.
Pardon?
It is good to have a regulator.
Good to have a regulator. Very good. Why?
Without a regulator, there's a probability that markets can collapse.
Okay. Regulations can have pluses and minuses. Right. Positives, like what you rightly said. The point you mentioned was? Sorry, can you repeat what you mentioned?
Markets can collapse without the regulator.
Yes. So markets they bring in some sort of stability of confidence into the market. Stability or confidence into the market. Now, if you take, for example, a market like Bitcoin. Bitcoins, regulated or unregulated? What are Bitcoins?
Digital currencies.
What currencies?
Digital currencies?
Yeah, digital currencies. Very good. Virtual currencies, Bitcoins. Right now, Bitcoin is not the only digital currency. There are other types of digital currencies as well, like Ethereum, Litecoins, so many other types of digital currencies, right? So this has now become the new means of exchange. And if you have been following markets, you would have noticed that recently even Elon Musk, who is Elon Musk?
Founder, Tesla Motors?
Yes, he's the founder of Tesla. Right? Earlier he had he founded PayPal and he sold it. Now he's running Tesla, and he also runs an interesting company, which his ambition is to send people to Mars. Right? What is the company? SpaceX. Very good. Right. So even Elon Musk recently purchased a whole stock of Bitcoins. Right now, the price of a Bitcoin about 10, 12 years ago was about $2 a Bitcoin. Right? One Bitcoin you could have bought for $2. Then it went about $70,000, even higher. And it has been very volatile. Huh? Today it's about $30,000 odd dollars. Around that. It went up to about $70,000. 12 years ago, if you had purchased one Bitcoin for $2, at a certain point, you could have sold it for about $70,000. In just 12 years, imagine the gains you could have made, no? $2, right? A Bitcoin. Okay, so say 12 years ago, for $2. And today, $70,000. Right? Unbelievable, isn't it? So $2, if you had spent 12 years ago, you maybe if you had $2 with you, perhaps you would have had a choice of maybe buying a pizza, right? $2. Or buying Bitcoins. A choice in life. Right? At that point, if you had thought that Bitcoin has no future, it's better to have a pizza today and enjoy, you would have bought a pizza. Right? But 12 years down the line, the guy who had purchased a Bitcoin will today end up with $70,000. He could have bought pizzas for the entire country, for the entire village at least. Isn't it? The same thing happened with shares of Tesla, right? If I'm not mistaken, there was an interesting story that well, if you had purchased Right, about 5-6 years ago, if you had purchased a Tesla or a Tesla car, right, or if you had the equivalent of the car, if you had purchased Tesla shares, the return disparity over the period of 5 years would have been something like this, because the Tesla price has just gone through the roof, whereas the car value does not appreciate. Right, in Sri Lanka it might, but not overseas. Okay, so remember, every decision you make, every decision, buy a pizza or invest your money in Bitcoin, can have significant results several years down the line. So it's the decision that you make today which defines your future. You may know it, you may not know it. Okay. So that's why decisions, every decision, little decision you make in your life, everything can have a significant impact, a ripple impact on your future. Yeah. Okay. It's called the butterfly effect. If you can change one thing, right? Imagine if you can change the past, right? If you had consumed a pizza at this point, you went back in time and told your old self, you idiot, don't eat your pizza, buy a Bitcoin. Imagine where you will be standing today. Right? So every decision you make has an impact on your life. Every split second you're defining your life. Isn't it? Sometimes it's quite scary also to think about it. So don't think too much about it. You lose a lot of sleep. Take things as they come. Okay, sorry. So we digressed a little bit. Now, regulations. We want to regulations. Okay. So Bitcoins, my point was Bitcoins are not regulated. There is no regulator for Bitcoins. As a result, Bitcoin is very volatile. Sometimes it goes to $70,000. Then all of a sudden it crashes and comes down by $10,000 a day. You never know. You can get burnt in a matter of minutes. Or you can become very rich in a matter of minutes if you invest in Bitcoins. Yeah. So Bitcoins bypasses all regulations, not regulated. There is no regulator. Yeah. So lots of people will prefer to trade in Bitcoins. Because for one thing, they can bypass regulations. Then transaction cost is minimal. Right? Okay, so regulators can bring in some sort of stability in the market, which builds confidence amongst investors. Okay. Now, if you want to invest, let's say you have some dollars and you have an opportunity to invest either in the US or in Afghanistan, right? You will obviously prefer to invest in the US because it's seemingly better regulated, right, than in Afghanistan. Okay, so regulators will bring in some sort of stability or confidence into the market. Very good point. What else? That's a positive. Anything else? Hello? Any other positives with regulations? I'll give you 2 minutes to think about it. Positives as well as negatives.
Regulator decides the ceiling rate and the floor rate of the interest in market.
Regulator decides the ceiling and the floor. Okay. Regulators can decide on threshold levels, right? Maybe a ceiling rate or a cap, something like maximum interest that you can charge on credit cards, right, or on personal loans, something like that. And so the regulator can impose certain restrictions. There is better control in the market. Okay, what else?
Protection to the participants.
Couldn't hear, sorry?
It gives protection to the participants.
Okay. They will protect the interest of participants. Meaning, if you buy an asset, they will give you some sort of assurance that you will receive the asset, right? So if you buy shares, there is some sort of an assurance that the shares you will receive the shares. And if you sell your shares, then there is an assurance that you will receive the cash. Yeah, what else? What about negatives? Now, what if I say that regulators will add cost to an organization, and there is a cost of compliance, right? For example, you need to set up or institutionalize a compliance department in an organization, right? So that you will have to recruit people, you will train them, which adds to the cost. So there will be a regulatory cost and also penalties, which is a negative. If you breach any regulations, there might be penalties. Cost in terms of implementation, staff, training, and penalties. What else? So regulations can bring in red tape. Okay, because if you want something implemented, you can't do it overnight, Like you might have to get regulatory approval, which takes time. Yes, there might be a certain amount of red tape. Isn't it? So there are positives as well as negatives. Then they might create a level playing field. So that markets are not manipulated. Not manipulated as much. Or minimum manipulation of markets. Yeah? Anything else?
Regulators can impact on the growth of negative impact on the growth of the industry.
I'm sorry, line is not clear. I couldn't hear you.
Regulators can have negative impact on the growth of that industry.
Regulators can have
Negative impact on the growth of the industry.
Okay, yeah. Perhaps they can reduce the rapid growth of an industry. Right. But the implementation of rules and regulations will safeguard interests of participants. Okay. So these are the pluses and minuses of regulations, isn't it? Now, it's like traffic police, right? So if there are no traffic police, there'll be probably blatant violations of road rules. But because of the cops, whether they're effective or not, we don't know. But at least there is some sort of control. No? Otherwise, all hell will break loose. Right? Right, so that is money markets. Then moving on to capital markets, we discussed debt instruments, types of instruments. And when you look at debt, credit rating is an important thing. Credit rating, right, given by rating agencies. Now, what are the main rating agencies in the world?
Moody's.
Huh? Moody's, yes. Only Moody's? Pardon?
Fitch rating.
Fitch, yes. What else? Hello?
ICRA.
Yeah, ICRA. And S&P, Standard & Poor. Right, so there are rating agencies. They will do an evaluation and assign a rating. Right. So what do you think is good? to have a good rating or a bad rating? Right, you have two types of credit ratings. It can either be investment grade or non-investment grade. What is the highest possible investment grade? AAA. And after AAA? After AAA you get?
AAA minus?
No, it's AA plus. Then AA minus, A plus, A minus, and then triple B plus, triple B minus. Right, so highest possible investment grade is AAA, lowest possible triple B minus. The non-investment grade, what is the highest? Double B plus. Right. Then you get to double B minus, B plus, B minus. Then comes triple C plus, triple C minus. Then you get the default ratings after that. Now where is Sri Lanka? Sri Lanka's credit rating? Sorry, non-investment grade is also called junk. Where is Sri Lanka's investment credit rating? Sri Lanka is what?
Triple C.
Very good. We are here. Which is good or bad? Triple C is good or bad? Triple C is not that good. It's what we should ideally do is we should try and increase our ratings, right? Because most of the developed countries are AAA, like Japan, and we are languishing at CCC. Now, the impact is the lower the credit rating, what increases? When the credit rating reduces, what will increase?
Cost of borrowing.
Yeah, default risk will increase, right? So when default risk increases, inevitably there will be a higher risk premium. So we will be borrowing at very high rates. Very high rates. So that's why our sovereign bonds, dollar-denominated sovereign bonds, are trading at close to 20%. Right? Short tenors, around 20%, which is pretty bad, right? Because on dollars, our bonds are trading at 20%. Okay, so ideally, we should try and increase this, enhance it. So there is some light at the end of the tunnel because we have some inflows coming in, fortunately. And with that, hopefully, we will be able to overcome these external challenges and go up our credit ratings, improve on the credit ratings. Right? And thereby, we can reduce the interest rate at which we are borrowing. Huge relief. Then equity markets. Right. Now, when you go to capital markets, you have debt and equity, right? So in grade 2, we have discussed, studied, when we in grade 2, we have studied the differences between debt and equity. Now my question is, what are the differences between debt and equity? This is revision of grade 2. The differences between debt and equity. What?
So for debts, we don't have to pay any. For debts, we have to pay fixed amount of interest, but not for the equity.
Yeah. On debt, you have to pay interest. On equity, you have to pay. You don't pay interest, but you pay dividends, isn't it? On debt, you have to pay interest, but on equity, you don't pay interest, you pay dividends. Now, paying interest is compulsory. You can't say you cannot pay interest this year. If you say that, then it's as good as default. It's as if you are going to default, right? Because if you don't pay interest, it amounts to default. You are defaulting on your obligation. But if you don't pay dividends, it is not default. Because dividend payment is at the borrower's choice. Whereas interest payment is compulsory. There is no choice. You have to pay. Very good point. What else?
Debts are borrowed funds and equity is your own fund.
Okay. So debt is borrowed, whereas if you invest in equity, you become owners, isn't it? Meaning, if you have invested in debentures of, let's say, commercial bank or debentures of HNB, you are an investor. Just you have lent. And commercial bank or HNB have borrowed. But if you have invested in equity or of commercial bank or HNB, that means you are an owner of commercial bank or HNB. Right? It's a good point. What else?
Equity is more liquid, more riskier than the debt financing, equity finance.
Now, what do you think is more expensive? Debt is more expensive or equity is more expensive?
Debt is expensive.
Debt is expensive. Right. Which means equity is less expensive, right? Okay. Now, let's say you are an investor. So let me write that. Debt is expensive and equity is less expensive. Meaning, for example, let's just put some numbers. Say debt costs you 15% and equity costs you 10%, isn't it? That is in line with our argument that debt is more expensive than equity. So let's just assume debt costs you 15% and equity costs you 10%, right? Now, if you are an investor, if you look at these 2 points, where will you invest? Will you invest in debt or in equity? What do you think? If you are an investor, where will you invest? In debt or in equity?
In debt.
You will invest in?
Debt.
Debt, yes. Why? Because you take less risk and you're getting a higher return. Here you're taking additional risk, but you're getting lower return. That's why if you are in the right frame of mind, you will never invest in equity. Why? You take less risk and you get a higher return, isn't it? Right. So isn't that a contradiction? Then what happens is everybody will start investing only in debt. Nobody will invest in equity. Then, so actually, this argument is not correct. It's not necessarily correct. Because equity is more expensive than debt. More expensive than debt. Okay. Right. Now, these are the things that we have learned in grade 2 now. But what is the actual difference between debt and equity? See, Sri Lanka is looking for FDIs now, whereas we have external debt, right? So why are we very keen to get FDIs? If we can get debt, why not go with debt and not FDIs? But why are we so keen on FDIs? Now the reason is, let's say you're putting up a building with, you have two choices, either to fund it with debt, you issue debentures and source funding, or you issue equity and source funding. Two options. So you need, let's say, 1 billion by the debentures or equity, right? This is to put up a building. So let's say you go for debentures. You feel debentures will be the best source, and you raise the 1 billion through debentures, right? Now, after you put this building up, if there are no occupants, building is not being occupied by anyone, you don't get any revenues. No revenues coming in. But you have to keep paying the interest, no? Every year you have to keep paying the interest. You can't tell the lender that you have no occupants, no income, so you can't pay interest. You have to keep servicing the interest, right? If you don't pay the interest, they can sue you, right, for default. Okay. Meaning, if it's funded by debt, right, the risk of this performance is now with whom? If it has been debt funded, the risk of performance is with the borrower or with the investor. If it's debt funded, the risk of performance is with hello. If an investment is debt funded, the risk of performance is with whom?
With both parties.
Well, if it's unoccupied, you still have to pay your interest, no? So regardless of whether it is occupied or not, if it's debt funded, then the investor gets the interest, isn't it? He will receive interest. Correct? Right? But from the borrower's point of view, if you don't have revenues coming in, you still have to pay your obligations. Right? So the risk of performance is with the
borrower.
But what if it's equity funded? If no tenants, right? If you don't get any tenants, do you have to pay dividends? No, you don't have to declare dividends. Right? Then the investor has no return, but he can't sue the borrower. Okay, so the risk of performance, if it's equity funded, is with whom? The investor. That is the main difference between debt and equity. Risk of performance will shift from the borrower to the investor when it comes from debt to equity. Okay. Right. Okay, so foreign exchange market we will cover in detail, and derivatives also we will cover. Regulations. All right, so the next area is on foreign exchange. Shall you take a break and come back? Yeah.
Yes.
Do you normally get a break, or you continue without a break?
We get a break.
You get a break. Okay, 2 minutes. It's now
15 minutes. So 15 minutes usually.
15 minutes, my goodness. Okay. All right. Okay. So shall we start at 4 o'clock? Yeah. Okay, 4 o'clock. Right. So I'll see you at 4 o'clock. Let's take a break. Hello. Because I need to know where I should pitch this. If you have already covered foreign exchange in detail, we can maybe spend less time and move on. So how many of you have a thorough understanding of foreign exchange? How many of you want me to do it from scratch?
I do not have a thorough understanding, but I do have a basic idea.
Basic idea, okay. Anyone else? Okay, so shall I do the basics also so that there is some momentum going into it? Yeah. What do you all think? It is your call.
In the best interest of everyone, we'll do like that, no?
Best interest of everyone?
We'll do like that with the basic
from the
idea.
basic. Okay, okay. Right. Yeah. Well, I believe that all of you have done foreign exchange one way or the other. Yeah. For example, if you had gone to a bakery and bought a loaf of bread, then you are a master of foreign exchange, right? Or if you had gone to a bookstore and bought a pen, you are a master of foreign exchange. If you have purchased a bottle of water in your life, you are a master of foreign exchange. So there is nothing new to learn. Same thing. Why? Because this says a bottle of water is 50 rupees. Right? So you substitute dollars for the bottle, it will say $1 is 50 rupees, something like that. Same thing. Isn't it? Beyond that, there is nothing. So if you know how to buy a loaf of bread, you know foreign exchange. Absolutely nothing new to learn. Right? Everything else you learn on top of that will be technical knowledge. But if you know the mechanics of buying a loaf of bread, there is nothing new to learn. Okay, so always assume you're buying a loaf of bread or a mango or whatever you want. Okay, don't confuse it with dollars, euros and all that. No one understands that stuff. So always think of a dollar as a mango. That will simplify things, unless you don't like mangoes. Yeah. Okay, so why foreign exchange? Something that intrigued me for a long time. Why can't the whole world use one currency only? Now the Eurozone, there are about 19 countries or 19 odd countries. They use the euro. So likewise, why can't they widen the scope and for the whole world to use one currency? Maybe the euro or the dollar or even the Sri Lankan rupee, whatever. Why not? Why doesn't the whole world use one currency? If that was the case, we can simply skip this lesson and move on to the next one. Right? So that's one less thing to learn. If there was no foreign exchange. So why foreign exchange? Why can't we live with one currency? What do you think?
There are disparities among countries.
Yeah, sorry.
There are disparities among countries. So
yeah.
Cannot adapt to one currency.
Yes, very good point. So not every country is the same. No? Now take, for example, the amount of reserves that Sri Lanka has is not the same as the amount of reserves Bangladesh has or India has or even the US has, right? So not all countries are economically, in terms of economics, not every country is the same, right? We stand on different footings. Some countries are more developed than others. Some are less developed than others. So not every country is the same. What else? Now, if the whole world was using one currency, right, you will lose monetary policy independence. Why? Because countries will lose the ability to print money. You can't print money. Remember, when we started off, we mentioned that the central bank, and not only the central bank, even other foreign central banks have been printing money to reduce the burden on the economy because of COVID-19, right? To reduce the possibility of a liquidity crunch induced by moratoriums and all that. Okay, so printing money is basically increasing money supply. Now, when you increase money supply, interest rates normally drop. Yeah. So if you are printing money, if you are not using your own currency, you can't print money. No, no. For example, if the whole world was using Sri Lankan rupees, the US government can't print trillions of Sri Lankan rupees, right? It's not allowed. And Sri Lanka can't print US dollars if the whole world was using US dollars. And that is what happened to Greece. Greece defaulted on their debt because they could not print euros. Although euro is the currency they are using, they can't print euros. It's done by the European Central Bank, independent body. Right? So you will lose monetary policy independence if the whole world was using the same currency. Then there could be political reasons. Now, for example, US might not want to use the Chinese yuan as the currency. Or China might not want to use US dollar as their currency. Russia will not want to use the US dollar. US will not want to use ruble. So there could be political reasons. Right? For these reasons, the whole world is not using the same currency. But imagine if the whole world starts using Bitcoin, then this headache of foreign exchange will never arise. Right? Because everything will be quoted in bitcoins. You go overseas, you travel overseas, you don't have to worry about carrying a bucket load of money. No? Normally, when you go, you take dollar currency notes or whatever and go. No? Right? But if it was Bitcoin, no hassle, hassle free. Right? You can just walk into any shop you want, give your card, and they will charge you in bitcoins. Right? So it might come to that in the future. You never know when it will come. Might be sooner rather than later. Right? No one could tell, because the world is so dynamic. Okay. So if there are any questions, you can always ask me. Quite obviously, you need foreign exchange if you want to import, export, or if you want to invest in overseas countries. Right? So if you're a Sri Lankan country and a company and you want to invest overseas, then you will need foreign exchange, isn't it? Now, so many banks, some of you, there was one person, I think, from Commercial Bank, Bank of Ceylon. So all these banks have invested overseas. Now, Commercial Bank has a presence in Bangladesh, Maldives. Then Bank of Ceylon has a presence in India, London. Okay, so all these investments would have been made in those respective currencies. So if you want to invest overseas, you can't go and take a truckload of Sri Lankan rupees and invest. You need to have globally accepted currency, one of the major currencies. Right? And the market structure of foreign exchange, it is a around-the-clock market. It doesn't work on weekends. Right? The foreign exchange market is not open on a weekend. Although money changes and all that do function, foreign exchange markets remain closed. Right? There is no central location. You can't say that the foreign exchange market centrally operates from the US. It is over the counter. Right? It's like buying a loaf of bread, as I said initially. Same thing, you go to a shelf and buy the item you want. You can buy it over the counter. You don't have to go through an exchange. Liquidity is very high. Right? $5.3 trillion of volumes every day. $5.3 trillion. That's massive. FX market is one of the largest financial markets in the world. The daily volume is about $5.3 trillion, and transactions can be for trade, guarantees, investments, or for speculation. Okay, so trade backed. Might be for imports or exports, or for guarantees, right? Investments or speculation. Now, $5.3 trillion a day, huge amount. Every day, every single day, the foreign exchange market sees this kind of volume, massive. What do you think is roughly the Sri Lankan foreign exchange volume? The contribution from Sri Lanka to the foreign exchange market on a daily basis, on average, is how much? What do you think? About how much? Can you all guess? How much would Sri Lanka contribute on a daily basis to the foreign exchange market? What is our daily contribution to the volume of the 5.3 trillion? Just take a guess, anything. Yeah? Give me a number. It's okay, guys. Give me any number you want. Hello? How many trillions of dollars do we contribute? On average, about $100 million. That is Sri Lanka's contribution. So percentage. A little less than 0.002%. Negligible. Yeah. Also, which market do you think is the biggest? I'm referring to the last point. Transactions can be done for trade, guarantees, investment, or for speculation. Which market do you think is the biggest? Is it trade, guarantees, investments, or speculation? So I have given 4 choices. Trade, yeah. 25% chance of success. 1 in 4 of these answers are correct. You can try your luck. Trade, guarantees, investments, or speculation. Well, you can I can also give you 50-50 or even call a friend. I'll give you 50-50. Trade and speculation.
Speculation.
Speculation, yes. That's about 95% of the daily turnover is speculation. $5.3 trillion, 95% of that is speculation. Only 5% goes for the others. Okay. So imagine the amount of gambling that happens in the world every day. It's, well, actually not gambling, but trading. Trading in the sense speculative trading, not trading. Yeah, any questions up to now? No? And this is the how the market structure is, right? Singapore, when Sri Lanka opens, Singapore is open. So is Hong Kong. Japan is just about to close up. So UK also remains open, also opens up after we open. Now these are the main financial centers. Right? Most of the trades happen during UK time. That's because it overlaps between Asia as well as US. The major currencies, the G7 currencies, and the market participants. Right. Now, let's go to this diagram. Now, if you take Sri Lanka, just let's assume that Sri Lanka for now does not have any dollars. Then all of a sudden an exporter brings in dollars to the country. So that is how dollars come into the country, maybe through exporters, or we can even have remittances coming in. All the expatriates, most of the expatriates remit money to the country, right? So remittances also brings in dollars to the country. Then we can have grants, loans, all these will bring in dollars into the country. And so those dollars that come into the country, then initially will be routed to one bank. In this example, it has given as Bank A, and then Bank A will sell it to maybe to B. Part of it might go to C and D, and they then will start trading these dollars amongst themselves. And finally, an importer will take the dollars out of the country. Maybe a loan repayment might take the dollars out, right? So in between, central banks will also intervene in the market. That is to maintain the stability of a exchange rate. Right? Now, in countries like Singapore, there is no central bank. They have a system called the Monetary Authority of Singapore. So how they intervene in the market is they don't come and buy or sell dollars or Singapore dollars in the market. Right? What they do is they change the interest rate in the country. So based on interest rates, the foreign exchange rate starts moving. That's how Singapore manages the foreign exchange rate, based on interest rates. Right? So, but what it does is it eliminates contradiction between monetary policy and foreign exchange rates. And you now using only the interest rate to manage the exchange rate will eliminate contradictory policy adopted by a central bank. Whereas you can have contradictory policy if, let's say, you keep buying or you keep selling dollars to the market, right? If you're the central bank, if you sell dollars to the market, you should absorb liquidity now. Right? So the purpose there is to drain the market of rupee liquidity, right? You keep buying dollars, sorry, you keep selling dollars. When you sell dollars, the rupee gets absorbed, meaning rupees will be short in the market, right? If there is less supply of rupees in the market, rupee interest rates will have to go up. Okay, so if you start selling dollars to the market, the dollar should weaken and the rupee should strengthen. Correct? But you might have your monetary policy, on the other hand, might be printing money. You might be printing money to reduce interest rates. So that is contradictory policies, right? you're selling dollars to the market and also printing money. Contradictory policies. Because on one side, you're selling dollars to bring down the exchange rate and to increase rupee interest rates. But if you keep printing money, it doesn't happen, right? That will bring down interest rates. Right. So these are the market participants. Importers and exporters can be corporates or individuals. Banks as an intermediary. Brokers, right? It is the brokers in Sri Lanka that bring banks together. Investors and speculators. And also central banks. Right. So any questions up to now? No questions? Right. Transaction dates, or trade date and value date. Right. Are they the same or are they different? What do you all think? Is the transaction date the same as value date, or can they be different?
Different dates.
Pardon?
Different dates.
Different.
Yes.
They don't mean the same thing. Okay, what is the
So
difference?
not necessarily.
Huh? Yeah, what is the difference between transaction date and value date?
Transaction date, you can decide that you will do a transaction on this date, but then actually the movements will happen on a future date. So that will have to consider as the value.
Right. Yeah. Yes, you're quite right. Now, what happens is by the way, you're married or unmarried?
Married.
Married, okay. Now, let's say about 10 years ago, maybe you were unmarried, right? I'm just assuming. So when you were a bachelor, let's say you saw your dream girl one day in the morning, right? You met her, you fell in love, and you thought you'll get married on the same day, right? So you saw her today, you get married on the same day. Okay. If that is the case, your trade date is today. Settlement date is also today. Trade date is the day you see the girl. Value date is the day you get married. Right? If they fall on the same day, that is called cash. Then you see her today. You decide to get married tomorrow. It is called term. You see the girl today, you decide to get married in 2 days. It is called spot. Anything beyond that is called a forward. Anything beyond the spot date is a forward. Right? So there's other 4 different days: cash, term, spot, and forward. Okay, so the day that you enter into the transaction is the transaction date. The day where the settlement happens is called value date. Right? Now let me ask you a question. Let's say a customer comes to you and he tells you to do, let's say, RTGS transfer on the 15th of July, right? 2 million rupee RTGS transfer to another bank on the 15th of July. When will you debit the customer's account for the 2 million rupees? When will you debit the account? He wants you to do the RTGS on the 15th. When should you debit the customer's account?
I can debit the customer's account today, giving value on the 15th.
Debit the customer's account today?
Yes, but I'll instruct the treasury to effect the transfer on the 15th.
Why will you do that?
Because the customer wanted the funds to be credited to, the transaction to be happen on the 15th.
Okay, okay. Now let's assume that the customer had 5 million bucks in his account, right? Okay. So if you debit the customer's account today, he will be left with 3 million rupees today. Correct? Right or wrong? Hello?
Yes, sir.
Yeah. So 5 million bucks, you debit 2 million. He will be left with 3 million, correct?
Yes.
Right. So today you have debited the customer's account.
Mm-hmm.
He should have had 5 million. He now has 2 million.
2 million.
So who has the money today? Customer, not in the customer's account. Who's holding the money?
The bank.
The bank is holding the money. So who's earning interest on it? The bank is earning or the customer is earning?
The bank is earning.
Bank is earning. Customer?
Yeah.
Has
Customer is at a loss.
Yeah. Have the funds left the bank?
No.
No. And the money belongs to whom? The bank or the customer?
The customer, actually.
Yeah. So who should get the interest?
Customer is benefited. Should be benefited.
Customer should get the interest. So you should only debit the customer's account on
15th.
The 15th. Correct?
Yes.
Yes. So in my view, it is wrong to debit the customer's account today itself. Yeah. But it's okay to have a lien. You can have
lien over the same savings account, whatever.
Pardon?
To have a lien over the customer's account without debiting his account and moving the funds to another account.
Exactly. Yes. So you can have a lien and you debit the account only on the 15th.
Understood. Understood.
Right. But I have found some banks don't practice that. They debit the account no sooner they receive the letter from the customer. Right. I have experienced it, which is a wrong practice. What are your thoughts? How about the others? Do you all agree or disagree? Yeah. The others would agree or disagree? No one agrees? Okay, let me put it in another way. Now, if you get a request from a customer to transfer 2 million to another bank on the 15th, what is the transaction date and what is the settlement value date or the settlement date? So trade date and the transaction date are the same. Value date, settlement date are also the same, right? They mean the same thing. Now, what is the transaction date and what is the settlement date? Or what is the trade date and what is the value date? Yeah. If you get the request today, then the trade date is today. Value date should be 15. Okay. I hope that was clear. So remember, trade date and value date are two different things.
What if the client maintains a current account?
Still, it is the same. You have no right
It
to.
is the same.
Yeah,
No right to debit unless the value date, isn't it? Okay.
Yes, yes. Because let's say on that particular day, right? Let's say the customer wants to get the funds transferred on the 15th, right? And for some purpose, maybe for migratory purposes or whatever, he wants a bank statement, right? He wants the bank statement on the as of the 14th. So if you debit the customer's account today itself, then the customer's balance will get reflected only as 3 million, no? Isn't it? Because the funds have not gone to the other bank. No? Because if he had already transferred the funds, then he could have showed the balances at both banks and the total would have been 5 million. Right? But if you take a statement today, he will only show, it will only reflect a balance of 3 million. 2 million short because you already debited, which is wrong practice. Now, if something like that happens, there is a high possibility that the customer might sue you because if his visa gets cancelled, right, he's short of $2 million to migrate, his visa gets cancelled, or his order maybe he wants to place an order with a supplier and he has to show his bank accounts. He is $2 million short, might get cancelled. He might lose millions of bucks because the bank has debited the account 3 days in advance. Clear?
Yes, sir. Understood.
Yeah. All right. So you need to be mindful of this. Just go back to your banks and see if it is being practiced, especially with corporate clients. Not only corporate clients, with all clients, it has to be the case, right? So just check your systems and see. Okay, I won't be surprised if most of you are debiting the customer's account on the moment you see the letter, right? The moment you see the letter, you debit the account. Not correct. All right. Yeah, good question. Very good question. What else? Any more? Okay, so no further questions. Let's move on. Now, let's say you want to buy a mango, right? And you go to Cargill's, let's say. We'll assume you're going to Cargill's to buy a mango. Now, when you go to Cargill's, the price of a mango, Cargill's will tell you the price, or you're telling the price to Cargill's. Let's say the price of a mango is 100 rupees. Okay. So is Cargill's giving you the price, or are you giving the price to Cargill's? Who quotes the price?
Cargill, no?
Yeah. The supermarket will give you the price. You don't go to the supermarket and tell them that the price of the mango should be 50 rupees. You can't do that. Right? Whatever the price they give, only you can put. Yeah, you can use. Right? So Cargill is quoting the price. They are called the quoter. You are asking the price from Cargill. You are the asker. Right? Quoter and the asker. So Cargill is called the market maker. And you are the market taker. Now, when you go to a bank and you want to buy foreign exchange, let's say you're traveling abroad and you want to buy foreign exchange, the bank will tell you the exchange rate. You can't go and tell the bank that the exchange rate is this. You will have to use the rate that is quoted by the bank. Maybe you might be able to negotiate here and there, but overall the bank will tell you what the exchange rate is, right? It's not you who's going to tell the bank. So the bank is quoting the rate to you. They are the quoter. You're asking the rate from the bank. So the bank is the market maker and you are the market taker. Clear? Right. So the exchange rate is value of one unit of currency in terms of another currency. Right. How much is, for example, one mango is 100 rupees. Right. So that is how much is one mango in terms of rupees. Exchange rate. So instead of mangoes, if you can put dollars, it gives you the exchange rate, 132 in this case. By the way, now that we mentioned, see at the very beginning, we discussed that if the whole world was using the same currency, right? You lose monetary policy independence. Remember we discussed? And then we went on to discuss that countries like Singapore have an advanced system where the monetary authority of Singapore uses interest rates to decide on the destinies of the exchange rate, but so that it doesn't contradict with the monetary policy. Right? So interest rates will control exchange rates. But if you have contradictory monetary policy, it can be a disaster, can be a real disaster. Take, for example, a country like Zimbabwe. Now, what happened to the Zimbabwe dollar? Any idea?
They started printing without a control, without a limit.
Yes. Yeah. There was money printing, heavy money printing by Zimbabwe. Right? And what happened to the Zimbabwe dollar? What do you think is the exchange rate in Zimbabwe? How much is $1 US in Zimbabwe dollars?
350 Zimbabwe dollars.
350.
Approximately.
Very good. Good try. It was 35, right? A little more than that. 35,000, but 35 million. It didn't stop there. Right? To 35 billion. And then 35 trillion. It actually went to 35. What's it called?
Zillion?
35 quadrillion. So one US dollar went to 35 quadrillion Zimbabwe dollars. Now, why did this happen? Unbelievable, no? $35 quadrillion. Right. Now, let's say a person lives for 100 years, right? 100 years. So, if you take the number of seconds this person lives, the day he was born up to 100 years, then the number of seconds, 60 seconds, you have 60 minutes. Then that's the number of seconds per day. 365 into 100. Right? So that is close to 3 million. Isn't it? So he has this many seconds. Every second, if he counts a Zimbabwe dollar, and every second he counts Zimbabwe dollar from the time he was born until the moment he dies. His job is only to count Zimbabwe dollars. He will never get to $1. Right? Maximum he will get is 3 billion, 153.6 million. So that is about still about 1 million times. Roughly about 1 million times. Well, he has to have 1 million lifetimes to count 35 quadrillion Zimbabwe dollars, right? Isn't it? So after 1 million births, 1 million lifetimes, then he will get eventually to $1 million. Even that is not enough. Isn't it? Disaster. Right? So the Zimbabwe Central Bank had no choice but to abandon their baby. No more Zimbabwe dollars. It is now a collector's item. They had to scrap their currency. Why? Why did this happen? Okay, so the easiest way for you all to become quadrillionaires, if you don't have to do any of these exams, why do banking? Why study? Take $1 and go to Zimbabwe, you become a quadrillionaire. take $1 and go, you will have to get a couple of container loads of, you will get a couple of container loads full of Zimbabwe dollars. So you need not acquire any qualifications. Take $1, just migrate to Zimbabwe. Overnight quadrillion. Okay. So to buy a loaf of bread, you will have to carry a wheelbarrow, couple of wheelbarrows full of Zimbabwe dollars. And in Zimbabwe, you have currency notes stacked up on the streets. Value for money is absolute zero. So why did it get to that? Yeah, why did it get to that? What was the root cause? You all just mentioned it. Money printing. Quite right. Money printing. So why can money printing become a disaster? Well, it's because Zimbabwe had runaway inflation. The inflation rate hit some 200%, sometimes 500%. So overnight, the prices of goods and services will double overnight. That bad. Now, when prices are going up, when inflation is out of control, interest rates go up. And interest rates go up. Now, what did the Zimbabwe central bank do to control interest rates? They printed money. They printed money. When money is printed and it comes to the economy, printed money comes to the economy, it reduces money supply and interest rates will drop. Right? When interest rates drop, what happens? When interest rates drop, consumption will increase. Okay? So Zimbabweans love to import. They don't manufacture anything in their country, nothing. No manufacturing. So whatever they consume is imported. Right? Then when they import, to import they need dollars to the country. Dollars, more and more dollars to import. So the demand for dollar goes up. When the demand for the dollar goes up, the dollar strengthens. Isn't it? The price of the dollar will go up. The price of the dollar goes up. When the price of the dollar goes up, the cost of imports also go up. Imports will cost you more. Just assume if you are importing, last year if the dollar was 100, this year if it's 200, this year your cost will be double. Right? So the dollar price goes up. The price of the dollar goes up. Cost of imports go up. When cost of imports go up, when the price goes up, inflation is up. Inflation is increasing. Now inflation again up. Right? Because inflation has gone up. To bring down inflation went up. So interest rates also go up. To bring down interest rates, again money printing. They print money. Print money, increase supply, interest rates down. When interest rates are down, people start spending more and more, consuming more. Right? Consuming more because Zimbabweans love to eat and drink like Sri Lankans. So the consumption means more imports. Higher consumption leads to more imports. Right? So it drives imports up. More demand for dollars. The dollar price goes up again. When the dollar price goes up, again, the price of goods imported go up. Right? Price of going up, of goods and services going up is again inflation, again interest rates. Right? To bring down interest rates, again money printing. Increase supply, reduce interest rates, consumption again goes up. Right? More imports, higher dollar price, higher inflation, again money printing, bring down interest rates. Right? It became a cycle. Cycle, huh? It's a cycle. Good cycle or a bad cycle? Was it a good cycle or a bad cycle? The cycle that we just discussed, good or bad?
Good for the people, bad for the economy, no?
Yes, bad for the economy. So bad for the economy means bad for the people also, isn't it?
True, true.
Yeah.
So central bank printed money to reduce that interest rate was like that can't be.
Sorry, Sampath, the line is not very clear. Connection is not very clear. I couldn't hear. I couldn't follow you. Can you repeat, please?
The central bank of that Zimbabwean dollars is printed to bring down that interest rate, no?
Yeah.
Like in Sri Lanka, can't they set the floor rate and the ceiling rate for interest rate without printing money?
Put a floor and a ceiling.
Yes.
Yeah, but then inflation was very high, 200%. Where do you put the floor? Where do you put the ceiling?
That's because both are in high. That's why we can't do that, no?
Yeah, probably what they should have done is before they started printing money, they should have probably increased interest rates so that consumption will drop. Right? It will reduce consumption, and that will automatically control the exchange rate also. But maybe it may have been a little unpopular decision at the time. So probably that's why they didn't increase interest rates. Right? They wanted consumption to continue. Because if you increase interest rates, consumption will reduce. So if consumption drops, that will also reduce the quality of life, isn't it? Because if, say, interest, now, for example, if the housing loan rate is at 7%, there will be a tendency for people to take more and more housing loans. But if the housing loan rate is 20%, then the demand for housing rate loans will drop, right? So people may not, well, go for new housing. They might either renovate their existing homes or live on rent. So the same thing can happen in vehicles also. If the personal loan rate goes up or leasing rates go up, people might not buy new vehicles. They might repair and maintain their old vehicles, right? So more breakdowns and all that will also come, and quality of life will drop, no? Quality of life will drop. Right? So it's not an easy decision to make, huh? To increase interest rates. So many other aspects to look at. Right? So it's not easy at all. Okay, so that was money printing, and Sampath, you need not worry because this is Zimbabwe, but Sri Lankan dollar rupees still only 200. This is a long way away.
Sir, what is the currency now using in Zimbabwe? Still the Zimbabwean dollars?
No, Disha. They use the US dollar and the South African rand as proxies. Zimbabwe dollar is not used anymore.
Thank you, sir.
Yeah. Then something similar happened in Philippines. It didn't go to 35 quadrillion, but it went to about $10,000. 10,000 rupiah. Right. Indonesia. That's after the East Asian economic crisis. Okay, understood? Any further questions? No? So money printing can be a disaster if it's not properly controlled.
So if we do not control imports, that any country can face that situation.
Come again?
If that we do not control the imports.
If we don't control imports.
Yeah.
Yes.
See, that happened to Zimbabwe because they did not control that import.
Yeah, and if Zimbabwe had controlled imports, then again the quality of life will drop, no?
Yeah.
Yeah.
They didn't have export.
Yes.
They should have export also.
That's the thing. Maybe what they could have done is initially to increase interest rates, increase reserves in the country, and then use the reserves for developing the country. Like more investments into the country. Right, and then like what the Sri Lankan government is doing to develop the local producers, local manufacturers and all that. Right now there is an increased focus in Sri Lanka on domestic production. Right, so many things we are trying to produce so many things locally. Because of the reason that you mentioned, it will preserve our reserves. Right? So that is what Zimbabwe should have done probably. They should have maybe tried to enhance the local or encourage local manufacturing. Alongside reducing imports.
So that printing money that push is the main reason for inflation, no? Usually, the printing pushes inflation.
Yes. Yes. It can lead to inflation. That's the traditional thinking. Well, it's something like this. Let's say the only asset in the world, let's say, is books. Right. Let's just assume that all the assets in the world are constant. It doesn't increase. And if this is worth $1 million, right? Sorry, let's say there are 100 citizens in the country. Right. So it's not worth 1 million. Let's say there are 100 citizens in the country, and the total economy is $1 million. Right. So $1 million meaning each of them, if the income is equally distributed, will have about $10,000 at their disposal. Okay, so each of them have $10,000, and if all of them want the same product, right, all of them want the same product, they will spend up to a maximum of 10,000 to purchase this. Okay, so they will buy this at 1 million. But if money is printed, let's say it was doubled, another 1 million was printed, Each of them get 20,000 bucks. Now they will push the price up to 2 million. Yeah. So the price keeps going up. Isn't it? But on the other hand, the disposable income also keeps going up. Okay. All right, so that was an interesting discussion. Thank you. Okay. Right, now let's say you go to a supermarket and you notice that the price of one mango is 200 bucks. Okay, so one mango is quoted at 200 bucks. In other words, you can say the mango to rupee exchange rate is 200. Right? So here you are giving the price of one mango in terms of rupees is 200. The price of one mango in rupees, isn't it? It's not the price of 1 rupee in terms of mangoes, but the price of one mango in rupees. Okay. Now, so there are two currencies, mango and the rupee. The currency that you write first is called the base currency. And the currency that you write second is called the counter currency. Base currency and counter currency. Very easy to remember. Right. Whatever currency you write first is base. Whatever currency you write second is the counter. You always quote the base currency in terms of counter currency rates. So these are the fundamental things, and these are the things that you should know. Okay, if you know this, you will not go wrong. Clear? Very easy to remember. Whatever currency you write first is base. Whatever currency you write second is the counter. Understood? Any questions? No? Well, if it comes to exchange, when it comes to exchange rate, the only thing you need to do is, without writing mango, you put dollar. And so this would have been $1 is 200 LKR. Sorry. 200 LKR. Or in other words, this is the dollar to rupee exchange rate, 200 rupees. This is base and this is the counter. Okay, so I hope that was clear. Right. So let's say the dollar against rupee is 200. Now for a Sri Lankan, dollar is the foreign currency, rupee local currency, right? So we have quoted 1 unit of this is $1 is in rupee terms. The 1 unit of foreign currency in local currency terms is 200. Right? 1 foreign currency unit in terms of local currency is 200. Okay. So if it's quoted like that, it's called a direct quote. This is called a direct quote. On the other hand, you could also have said the rupee to dollar exchange rate is 1/200, which is about 0.005. Right? Now this gives 1 unit of local currency in terms of foreign currency. 1 unit of local currency in terms of foreign currency. 0.005. Right? 1 local currency in terms of foreign currency is called an indirect quote. Direct quote and indirect quote. Remember that. Yeah. But in practice, the practice is a little different. Practice says if dollar is written first, it's called a direct quote. And if the dollar is written second, it is called an indirect quote. Okay, that's in practice. Yeah. Practically, there are 4 currencies which gives the dollar second, which writes the dollar second as the counter currency. But out of the major currency, it's the Aussie dollar, Euro, Sterling, and New Zealand dollar. Right? But there are other smaller currencies also, where the dollar is written second. Right, purchasing power parity. Now there are a couple of theories when it comes to foreign exchange. One is purchasing power parity. Other one is called interest rate parity. So what do you mean by purchasing power parity? Any idea? What is meant by purchasing power parity?
Comparing the purchasing power?
Yeah. Come again?
Comparing the purchasing power?
Comparing the purchasing power. Yes. Okay. Very good. All right. I'll explain using an example. And it's also called the Big Mac theory for a reason. Now let's say in the US, right? The price of one Big Mac, let us assume, is $5, right? $5 in the US. Then the same size Big Mac, the same taste, everything is identical. Nothing is different in Sri Lanka, right? Let's say the price is 1,000 rupees. In Sri Lanka. Right. So what purchasing power parity says, the identical product in two different countries, the price of an identical product in two different countries will reflect the exchange rate between the two currencies, the two countries. The price of an identical product in two different countries will reflect the exchange rate between the two currencies. So in this case, the exchange rate will be 200. $1 will be 200 rupees. Okay. That is purchasing power parity. But there are arguments against purchasing power parity. Why? Because the Big Mac, when brought to Sri Lanka, there are logistic costs. The cost of logistics, transport, refrigeration, all that gets added. Then there will be taxes. So that distorts purchasing power parity. Otherwise, it will be almost the same, isn't it? So whether you go to US and buy a Big Mac, or whether you buy the same Big Mac in Sri Lanka, you should be indifferent. It goes by the exchange rate parity, the purchasing power parity. Okay. Understood? Any questions on that? Let's just run through this example. It says, for example, a chocolate bar that sells for 1.5 Canadian dollars in Canadian city should cost $1 in US, where the exchange rate between Canada and US is 1.5. Right, now let me ask you another question. In this case, the US dollar to rupee exchange rate is 200. Okay. The dollar rupee exchange rate is 200. Now, which currency is stronger? The dollar is stronger, the rupee is stronger. Which is a stronger currency?
Dollar is stronger, no?
Dollar is stronger. Yes, you're right. Why do you say the dollar is stronger?
Because you have to buy a dollar unit, you have to pay like 200 times of the other currencies unit.
Yeah. All right. Now the example that we just did, it says $1 against Canadian dollars is 1.5. Isn't it? It costs $1 in the US, and in Canada it costs 1.5 Canadian dollars, right? So purchasing power parity gives an exchange rate of 1.5 US Canadian. So which is the stronger currency out of this pair? The dollar or the Canadian dollar? US dollar or the Canadian dollar? I can give you three options. First option is the dollar, US dollar. Second option is the Canadian dollar. Third option is both are equal. Right, so I can further simplify it for you. I can give you 50-50. The dollar is stronger. Second one, Canadian dollar is stronger. What is your answer? Which currency is the stronger one?
Dollar is strong.
Dollar is stronger.
Which one?
Dollar, US dollar.
US dollar is stronger. Okay, why? Why do you say the US dollar is strong?
Because you have to pay 1.5 Canadian dollar to buy a dollar.
1.5 Canadian dollars to buy $1. Okay.
Yes.
Good. Yeah, you're right. You're right. You're quite right. So what if I do this? What if I say Singapore dollar to Canadian dollar? It's 0.95. Sorry, before that, now US dollar rupee 200. What is the base currency? Base currency is the dollar, right? US dollar in the first currency is always the base. Huh? Second case, it is the US dollar. Now, Singapore dollar, Canadian dollar. Which one is the base currency?
Singapore dollar.
Singapore dollar is the base currency, right? Because it's the currency that you wrote first. Whatever the currency you write first is always the base. Yeah. So out of these two currencies, which one is stronger? Singapore dollar is stronger or the Canadian dollar is stronger?
Canadian dollar.
Canadian dollar is stronger. Okay. Why?
Canadian dollar.
Why?
Because you are paying less than one to purchase a Canadian dollar.
Very good. Very good. That's the logical way of thinking it. But if you want a shortcut, can I tell you the shortcut also? Can I give you a shortcut? You're right. You're 100% correct. On these exchange rates, the first two are more than one or less than one?
More than one.
More than one. If the exchange rate is more than one, the base currency is stronger. Right? But if the exchange rate is less than one, then the base currency is weak. Yeah. So if exchange rate is more than one, base is strong. And if exchange rate less than one, base is weak. Clear? Understood? Yeah, so any questions from today? All right, so if there are no questions, we can wind up for today, and I will see you all next week, same time. Thank you very much. Have a safe week.
Yes.
Stay safe.
I have more clarification. Sir?
Yeah.
We heard that US subprime mortgage fund, at that time that reserve chairman has been the Ben Bernanke.
Ben Bernanke, yeah, you're right.
But is it Alan Greenspan? You said that it is Alan Greenspan?
No, I said that it began in 2000, early 2000s, right? Alan Greenspan was chairman until I think 2004, 2005. So the subprime mortgage crisis, it started in early 2000, right? The root cause was in 2000 when US interest rates were low. And it hit the fan when Bernanke was there in 2008. Okay? And Janet Yellen had to find the solutions.